So that's one thing about multifamily is, a lot of people assume because there's tenants in place, it's good to go. But
Welcome to Building Wealth Through Real Estate. If you invest or desire to invest in real estate, then this show is exactly what you need. And here's why. We all know that the number one thing that you should be doing as an investor is networking. Your network equals your net worth. But how can you use this to your advantage? Well, firstly, take notes. Listen to what the guests have to say. If you're a new investor, you can learn from the mistakes that they've made, the experiences that they've gone through, and learn how they think. If you're an experienced investor, you could see strategies that they may be implementing that you haven't thought of using yourself. Now, secondly, you may have questions, and if you do, great. Put them in the comment section down below, and this way we can be sure to get those questions answered for you. And thirdly, there's a ton of information out there, but I found that most of it is relevant to the US, and it's hard to try and take out and extract and see what's relevant to your area. So all of the guests that I'll be interviewing are Canadian investors. So if you invest in Canada, if you're interested in investing in Canada, then this show is exactly what you need. Joining us today is Mr. James Knull. James, could you tell our listeners a little bit about yourself, how you got started, and your journey to this point?
sure, thanks for the question, El Ray. I'm joining everybody live from one of the prettiest neighborhoods in Vancouver. I'm out for a little stroll. I thought I would share for everybody who's in Edmonton in the cold right now. It's a nice fall afternoon here in Vancouver, and it's still quite lovely. So, for everybody in Vancouver, you know what I'm talking about. I'm James. I'm the CEO of the Mogul Realty Group. We're a real estate team in Western Canada. We've got our Alberta headquarters in Edmonton, Vancouver headquarters. Our BC headquarters is in Vancouver, and we work with investors primarily. I I personally, I think I'm here to talk about my own investing journey. Started with single family houses, ended up with a couple of dozen of them, and then moved into buying multifamily apartment buildings, and currently have 13 of them, and always looking for more if anything comes across my desk.
Perfect. Yeah. Honestly, getting to this point is truly impressive, but it doesn't come without challenges. And the most common challenge that people face is raising capital. I'm not sure if you'd agree. At what point in your journey did you run out of using your own money, and how did you go about getting your first money partner?
I would say almost immediately. I started investing as a very young man, and I bought my first property at 5% down, house hacking, as they say, renting out all the rooms to my friends. And we had a great time. It was a fun place to live with all my buddies. So for my second property, I was already raising capital. And the way that I got started is I knew that most people were going to say no because I was young and inexperienced. And all I had for me was a lot of energy and a lot of determination. So the way that I got started and the way that I ended up with my first yes was I asked pretty much any adult who would pay attention to me if I could show them my business plan. So I said, hey, you know what? I'm developing a business plan. I don't even have a business degree. I don't know a lot about business plans. I would love to get your feedback on my business plan if you'd be willing to give me the time. And I mean, everybody loves giving feedback. So I ended up being able to do my presentation to dozens and dozens of people. And I'd start the presentation saying, okay, I really want to practice my skills here. So if at any point it feels like I'm being pushy or like I'm pitching or something like that, let me know because that's not my intention. And I'm just assuming that you're going to not be interested anyways. I just want to get some feedback and I want to try to improve my business plan so that someday I can execute on it. And for the most part, people were just polite, gave me feedback, whatever. But every time I presented them the business plan, I incorporated the feedback and the presentation got better and better and better. And finally somebody said, "Hey, wait a second. Are you actually going to do this?" And I said, "Yeah." And they said, I think I might be interested in doing a project like that. And I said, "Okay, well, why don't we sign a letter of intent and I'll go looking for a property that matches this description. And if it works out for you, then we can start talking about doing a deal." And sure enough, that's how I got my first joint venture.
Impressive. And this person, were they like within your inner circle?
No, no, they were not. Um, I mean, I definitely talked to people in my inner circle. And then the interesting thing about the people in my inner circle is a lot of them who said no at the very start, 3 or 4 years later, once I had a bunch of bought properties and the success was starting to come, they came back around and said, "Hey, are you still buying houses? It looks like things are going well. What do you got on the go now?" So,
Yeah,
I found that a lot
absolutely.
of a lot of the no's really just mean not yet.
Yes.
And as long as you don't offend anybody, those not yets turn into sures when the time is right. This particular person was someone I met at a real estate networking event. I mean, I pitched all my parents' friends. I pitched my doctor, my dentist, my naturopath, the manager at the gym that I went to. Like literally anybody who was older than me who would allow me to sit down with them for an hour. I took the opportunity. Um, and that's really what got it done. So when I sat down with this person I met at a real estate networking event, I mean, I'm thinking they went to that event partially with the intention of looking for business opportunities, and all that practice paid off. And the opportunity I presented got their attention and they wanted to do the deal.
I love that approach. That's the first that I've heard someone take it to that level is asking for advice. People love giving advice. They love passing on their opinion, their knowledge, and it helped you hone in on your craft. Um, and honestly, I'm not sure if you mentioned this when you introduced yourself, but I mean, you're sitting at over 250 doors at the moment, right?
That's right. Yeah.
You can understand how you got to that level. Um, so, what advice do you have for people who are looking or who need to raise capital and approach people outside of their inner circle? Would you advise them to take the same approach?
Yeah. I mean, I really would. One of my personal philosophies is that the quality always comes from the quantity. There's the old phrase, practice makes perfect. Well, practice is quantity. So the only way that you're going to get good at anything is by practicing doing that thing. You're not going to get good at presenting a joint venture presentation by reading your joint venture package to yourself and then looking at properties online. You're going to get good at it by sitting down with people and talking to them. It's the only way. And so it's the mindset piece, the tough mental game you play is giving yourself permission to get no's and not and just going into every situation saying, okay, I'm here because I'm going to get a no, and that no is the learning I need to do to get closer to a yes. And in that approach, consistency always beats intensity. So instead of saying, oh, I have to go super hard and spend every waking hour of every day working on this and work myself to the bone, like some people do that, especially like, I mean, the younger you are, the more of that energy you have. But some people start this in their 30s, 40s, they've got kids. There's a finite amount of time and energy available. So it's all about setting a habit and an intention around consistency and just telling yourself, for example, every single week, I need to sit down with one person and practice my presentation. And that's not so bad. That's not super hard. And if that honest to goodness isn't feasible, okay, well, maybe you sit down with one person every 10 days or one person every 2 weeks or whatever it is. But every step gets you there. And, an analogy I usually use is it's like climbing a mountain. For anybody that's ever been on a big hike and climbed a mountain, if you start at the bottom of the mountain and look at the peak, that seems insane. It's like, how are we ever going to get there? It's so far away. You, especially if it's your first hike, you're like, I don't know if this is going to take me 2 hours or 20 hours. I have no idea. It just seems really far. But you just got to get moving and one step at a time. And, as long as you focus on consistently stepping forward, before you know it, you're halfway there and you're 3/4 of the way there. And then all of a sudden you're there. And building your real estate portfolio is the same. Just set little things that you can do consistently and they add up pretty fast. And one of the things I also noticed is there's like a positive feedback loop. Once you do your first few presentations, as soon as you get a little bit of success, you start having fun. It feels good. You're getting positive feedback. Well, then you think to yourself, maybe I can do two this week. Maybe I can do three this week. You know, it grows once you start getting it going. Um, so that's kind of the approach, and how I really thought about it at first is I knew that eventually a JV would happen. I didn't know when, I didn't know who, I didn't know where. I didn't even think to myself, hey, if I don't do it, some people are like, I need to do 5 deals this year. And that's never really how I've set my goals. My goal, I've always been, I'm going to do one presentation every week. And then maybe that'll lead to one this year, maybe it'll lead to 5. But whatever happens, it's going to lead me there. And, that really caused me to achieve a lot of my real estate goals faster than I ever could have imagined them by just focusing on that consistency.
Oh, I love that response. And here's why. I feel like most people focus on the goal, the end product. And I feel like the people who do really well, they focus on what are the things that I need to be doing consistently to get to the goal. And that's not acquiring more properties, it's going out and meeting up with possible joint venture partners, or doing that presentation over and over again, honing in on that skill. That's what people who are operating at a high level are doing, or at least one of the things. So focusing on those actions as opposed to the intangible goal, I think, is a lot smarter play. I also like the fact that you went and approached someone for a joint venture opportunity prior to locking the deal up, because you said you're going to go look for the deal once you found them. I know for a lot of people it's like chicken and the egg, like, I need to find the deal first before I can go out and look for joint venture
Yeah.
partners or that sort of thing. I like that approach as well, is work with what you have, and then the rest can fall into place. But speaking of finding properties, when you actively
Yeah.
looking to acquire more properties as a realtor, does this process differ for you? I mean, with regards to analyzing and viewing properties, you're doing this all the time for others, so you
Yeah.
have your finger on the market pulse, right? But could you touch on how this part of investing differs with you as a realtor, and maybe give some advice for non-realtors out there looking to invest to ensure that they can find good deals and just have an edge above other investors?
Yeah. As a realtor, part of what I do is, it's partially my job to look at deals all day. So I'm more actively looking at deals more often, just as a natural kind of part of my career. Now, looking at deals is just part of the equation. I mean, finding the deal is, say that you're doing renovations or anything like that. Well, maybe there's a synergy with how you do renovations. Like, it doesn't matter what else you do in your life. There's always going to be an opportunity for crossover. So, maybe you have an accounting background or a bookkeeping background, or you name it. There's going to be something you can pull from what you're currently doing to double up your efforts. As a realtor, I see a lot of deals, so that helps. I mean, I'm looking at them more frequently, and so more opportunities come my way. But that doesn't mean that a non-realtor isn't going to see a lot of deals if you put yourself out there. So, one of the basic things that you can do is make sure that you're working with an investment-focused realtor who is actively sending you deals on a regular basis. That's not hard to do. And then the other thing I like to make sure that is happening for our clients is focus on staying market aware. And that's, every realtor has access to an automatic search tool that sends out properties the second they hit the market. So that's easy to do. And that's something I'd highly recommend doing, is whatever your target area is, you want to see every property as it comes up. Even if it doesn't exactly match your criteria, you say, okay, that's what $400,000 looks like on the market right now. That's what 425 looks at it like on the market right now. And just knowing what's out there and what the market is doing will definitely help you identify a good deal when it comes up. Because if you're in a position where a realtor sends you a property and says, hey, pay attention to this one, it's a good deal, I think you're going to like it. If you haven't been already actively paying attention to the market, then you're not going to know if that's true. And then instead of being able to take action, you're going to panic, or you start doing your research at that point. And it might already be too late. You might not have time to do research. So it's it's one of the useful things to do is just constantly keep an eye on what's happening so that you've got a good feel for what's going on in your market. And then the other thing is build a relationship with an investment oriented realtor and show them that you're serious. Um, Most realtors will give you, 3 or 4 opportunities to grab a really good deal, but it if you tie up multiple properties without actually moving forward for a good reason, you're going to start working your way down the list of a good realtor. So make sure that you can look at deals all day long, but if you're going to start writing offers, make sure you have a pretty good chance of actually closing. Otherwise, you're gonna lower your profile in the eyes of whoever's sending you those deals because they're gonna say, okay, this person isn't serious. They just tie up properties, so that property is gonna go to other people first before it goes to you.
I love that. I love that. And that ties back to what we just spoke about and how you touched on you approaching a joint venture partner and then getting the deal. So if you go out and you do your presentations and you find a joint venture partner, and at the same time you take these practical steps, finding an investment focused realtor, having them send you leads consistently, keeping your finger on the market, and then pulling the trigger once you see those good deals. Because that's one thing is I feel like successful investors, or I know successful investors, are very decisive. And when they see a good opportunity, they don't sleep on it, they act quickly. And I think that will allow you to act quickly. So I think this episode is really off to a great start. There's actionable steps that people can follow. So I am loving it. Now, you've been investing for a long time. What have you done to adjust your strategy along the way when the market has shifted to either take advantage of or protect yourself against new market conditions? And what key factors are you considering when doing so?
Yeah, I would say though, one of the things that's going to protect you from every market inevitability is be very, very cautious with how much leverage you use. And for new investors, you don't have a lot of money, and it's there's all kinds of talk about, oh, I got a deal for 0 down, or I got a deal for 5% down, or we want to get a VTB, a vendor take back mortgage, and it's all about borrowing more money to invest. But the thing about borrowing more money is more money borrowed equals more payments. And even though when the old thought process that when you put 0 down, your return on investment is infinite because you put in no money. Well, that's true. But if you can't get that deal to the finish line or exit strategy because you can't handle the monthly payments, then it doesn't really matter. And we're really seeing the negative effects of that happen right now because payments are increasing. So, if you've bought a property, put 20% down, but then borrowed an additional 20%, well, you're paying more monthly payment for that additional 20% that you borrowed. It can be very, very dangerous. So my caution is always be very, very wary of how much money you borrow because it can seem sexy on paper to put less money down and have a higher on paper ROI. But the that is almost always where investors fail when a problem happens, where there's a repair that coincides with a vacancy, with high payments, or interest payments go up, or it gets to be winter and it's tough to fill a vacancy because it's winter. Like that's literally the market we're in right now. So, people who are new investors sometimes think, oh, nobody's going to want to invest with me unless I can show them sky high return on investment by putting less money down and jacking up the leverage. But for the most part, the average investor, as soon as you can get that close to double digits and show them that there's a high degree of security and stability in that prediction, will be happy. And you don't need to add more money and more risk, or sorry, less money down and more risk, more payments, just to jack up the ROI because you think that's what you need for somebody to invest with you. So, it's almost always a better call to take less leverage than more leverage. And that's counterintuitive to, I think, what a lot of real estate experts say, but I can tell you right now, I've been in the industry long enough to see a lot of real estate experts get cleaned out because one little shift and all of those payments just erode the entire investment from the inside out before you have time to shore it up. So that's that's kind of the real mindset is, people are saying, oh, there's not really a lot of cash flow right now. Okay, so put 30% down, put 35% down. As an investor, that's kind of counterintuitive, but your partner might have that much money. So it's not really that outrageous for someone to put 150 into a deal instead of 100 or something like that, if it maintains the security of the deal. And then, you've got a midterm refinance strategy that pulls that equity back out when the interest rates soften. Okay, so those are just like kind of little things that you can do from a borrowing perspective that adds a lot of safety, security, and de-risks the deal. Borrowing, the more money you borrow, the riskier it gets, and that's something you have to be really careful about. The other approach in this market is cash flow mitigation strategies. And what I mean by that is cash flow is way harder to come by right now, way harder to come by. So there's only certain ways that you can deal with that. Way number one, put less money into the deal, borrow less money, have lower payments. Way number two is have a budget item line for your short-term negative cash flow while you wait for payments to either go down or rents to come up. So a lot of people will buy a property and, let's say, furnish it to increase the monthly rental amount. Okay, but if you're spending $20,000 on furniture, by the time you hit month 6, that furniture is only worth $10,000. It can often just be a little bit easier, a little bit less risky, a little bit less management, and fewer moving parts to just put $10,000 aside in an account that subsidizes the negative cash flow until the market comes up from a rental perspective or comes down from an interest rate perspective. And you're achieving the same goal without adding all the complexity. That being said, furnished rentals, either monthly or nightly, Airbnb style, cash flow way more. So that might be the solution. But trying to, quote unquote, find something that cash flows, very hard right now. There's not a lot that cash flows. There are certain cities that cash flow even, Toronto, Vancouver, it's more expensive. The cash flow is even less. But even in traditional cash flow markets like Edmonton, it's hard to get cash flow right now. So you have to figure out a strategy that helps you deal with lower cash flow. I think the last strategy you could probably employ is self-property management. We always want to be efficient, delegate, work with a team. But if you're a new investor and you only have a small handful of properties, the amount of money that you can save by self-managing for a couple of years and just pulling up your socks might be the difference between breaking even and going negative. So just accept it. Accept that work might be part of your business plan for a little while. And then, the day that you actually get to hire a property manager is a good day.
I love that. Gold. You gave more than what I even asked for, and you really, really dove into that question. So yeah, firstly, I think that's an awesome approach is, of course, watching your financing, because I think it's easier for people to go out there and finance more than it is to get the money partner, right? So you can be lazier about it and try and get like more financing, or you can go out and work on your partnerships, work on your presentations, on getting money partners. And then for the deals that you do currently have that aren't cash flowing is being creative with that. Now, I've heard people say, short-term rentals, Airbnbs, lease options, those sort of things. But I like the fact that you also brought in a different perspective, is considering whether keeping that money may not be the better strategy for you, and then just subsidizing the negative cash flow and riding it out. I feel like that's one thing that's less spoken about as well. And then diving in, speaking of markets, because you compared like Edmonton is more cash flow heavy versus Ontario and BC. If we look at the geographical scale, you've invested in Alberta, British Columbia, both
Mm-hmm.
completely different markets. Do you adjust your investment strategy between the two? Perhaps with Alberta being more cash flow intensive than BC and maybe BC for more long term appreciation, or do you find that your strategy is quite similar in the scope that you use to invest?
I think you hit the nail on the head there when you said that when I'm investing in BC, we're counting on growth. BC is a market that has grown in the past, and will very likely grow in the future. And so a lot of the investing out in BC really relies on that growth and relies on counting for that growth. And even when BC is just cyclical as well. Most real estate markets are. But when BC goes through a cycle, it's usually a year or two of non-growth. And then when the growth comes back, it's explosive. Whereas, in Edmonton, we'll have a year of strong-ish growth, and then it goes down or flatlines for like 5 or 6 years. So in Edmonton, because of that, the properties keep getting less expensive relative to BC. Right now in Edmonton, the prices are about one third to one quarter what the equivalent property in BC would be, which is substantial. It's actually crazy to think about. And so when that's the case, it better cash flow. Edmonton's main value proposition from a property perspective, I would say, is cash flow. And part of that is the easier to manage landlord tenant laws because it makes it easier to keep your cash flow going. Whereas in BC, we don't need to be as picky about cash flow because, if we're going to do some simple math, let's say that you're cash flowing negative $500 a month. If we multiply that by 12 months, that's negative 6,000. We multiply that by 5 years, that's negative 30,000. In BC, you'd be hard pressed to buy a property that didn't go up between $100,000 and $200,000 in 5 years. And that's a historical trend that's been going on for 3 decades now. So, it's a short-term loss for a long-term gain. And it's actually kind of tax efficient when you think about it, because that 30,000 that you write off at full income tax, whereas that 5-year gain is a capital gain. So you're kind of trading in a full pop loss for an increase in capital gain. So it's, again, for those of us that are cash flow investors, it's really, a lot of people, the conversation is hard stop, negative cash flow, don't like it. But when you look at the big picture, as long as that growth is fairly predictable, which it is in BC, there's a tax advantage as well as a net ROI advantage to investing in that way. Now, in any portfolio, diversity is what matters. So, I'm not going all in on either strategy. I just make sure that I have a bit of both so that my portfolio as a whole is, a good mix of different assets.
Yeah, that was actually going to be a question was, when choosing to invest, do you pick moments where you're like, okay, I think we need some more cash flow properties. Let's focus on Edmonton, or I think let's add to the appreciation side of things. We have excess monthly money that we can put into a cash flow negative property and hold this out for the long term. Let's look into BC. Do you sort of do that, or is it just like, hey, opportunity pops up the side, let's jump on that kind of thing?
Yeah, that's a great question. It is definitely opportunistic. Like my macro strategy will shift depending on the market and where the opportunities lie. So I will move my investments around or my investing around based on what the market's looking like. So a good example of that is right now in BC, we're actually just buying a bunch of pre-sales. And the reason for that is if it's going to be done in 3 years, within the next 3 years, this interest rate situation should more or less sort itself out. The market's at a very, very low point, which means that a lot of the developers are giving a bunch of incentives, which makes it easier to buy a pre-sale because the deals are better. And over the next 3 years, this massive inflation that's hitting the world will just push the rents up. So with a pre-sale right now, it's kind of a perfect storm where, number one, the value should go up. Number two, it allows you to just kind of wait out the high interest by parking capital without having to take negative cash flow on it. And then number three, in a perfect scenario, by the time the pre-sale is complete, interest rates should be back down, rents should be back up, and they might actually be a little bit closer to breaking even upon time for possession and completion. So that's my predominant strategy, is having lots of conversations with lots of developers in BC to just see when good pre-sale opportunities pop up. All that being said, if something comes across my desk in Edmonton or Calgary that checks every single one of my boxes, it's in a location I like, it's in a neighborhood I like, it's got good neighbors, it's a good quality property, the tenant profile is a good fit for my personal tenant profile, et cetera, et cetera. If it just checks all the boxes and is a great deal, I'll go for it. But when you're in a heavy growth phase in your portfolio, if you have a goal of acquiring 10 or 15 properties in a year, you're not buying all 10 out of 10s. You're going to have to buy a few properties that check 8 out of your 10 boxes or 7 out of your 10 boxes. 10s don't come along that often. So now that I've adjusted my strategy to be more pre-sale focused in BC, if something comes up in Alberta, it's got to be a 10. I'm not buying anything less than a 10 in terms of my personal criteria in Alberta right now. So that's kind of how I shift my strategy with the market. There's always room to buy a 10, but my predominant strategy is, if a pre-sale in Vancouver is a 9, still a good chance that I'll get it.
I love that. I honestly love that. That's so smart. Smart and unique, but you seem to be, I mean, really good with moving your money around and making it work hard for you. Now you started investing in single family and then moved to multifamily, right? I mean, which tends to be a popular strategy for investors looking to have a large portfolio of rental properties.
Mm-hmm.
In your opinion, is it better to start off with single family before jumping into multifamily just to minimize the scale of your initial mistakes? Or do you think it's a good idea for people who are already interested in multifamily to just jump right in from the beginning?
It's typically a personal choice. I mean, I started small with single family because I didn't have a lot of money. It takes less money to go into single family. And I mean, as a new investor, as a young investor, I wanted to start small and work my way up. It's kind of a natural progression, just like you said. There are people that just jump right into multifamily. Um, I find those people are typically higher net worth individuals because, if you're a small time investor and you're putting in, you have $50,000 to your name and you're putting in every last penny you have, and then you raise capital from a bunch of investors who are putting in every last penny they have, the stakes go way up. That's way more risky
Yeah.
and way more intense for everybody involved. But if you're an established individual and you've got a personal net worth of several $1 million, then you've got cash and other investments that's fairly liquid, and say that the $200,000 to $500,000 down payment on a multifamily building represents a sizable but not critical investment for you, it can make sense to start a multifamily. Multifamily is a much better asset class in a lot of ways because it's more efficient use of your capital. It's not, what I mean by that is if you have $500,000, it's, $500,000 is $500,000 down payments, which is, 5 houses in Edmonton. It's not 5 times more work to place $5 million in one building. It's actually about the same amount of work to get one building going as it is to get 5 houses going. So we know that time is actually the most important asset, not the money. So in the interest of utilizing your time more efficiently, multifamily always makes more sense. But that comes with the asterisks of the risk factor of how big you're going at what point in your career and what your current access is. So I would say 9 times out of 10, maybe even more often than that, it makes sense to start with single, get comfortable, understand the fundamentals of real estate investing, and then work your way up to multifamily from there. But again, someone who already has sizable net worth and good available capital might be a great candidate for starting in multi because, there's a reason everybody from single eventually wants to go for multi, is just because it's a better asset class to be in for a number of reasons.
100%. I completely agree on that, and that's where my thoughts were. But I know that's a question that people often toy with. So I think for the majority of people out there, it's probably best to start small, build a track record, get some hard-earned, experienced education, and then once you need to scale up, look at multifamily. Now, uh, one of the biggest problems that new investors face is analyzing deals. Just understanding how an investor thinks. So, would you mind if we run through one of your multifamily deals?
Sure. Yeah, let's do it.
Okay, perfect. So, how many units is this one, and where's it located?
So this one was 24 units located in Holyrood, fairly close to where the Holyrood LRT station is now open in Edmonton.
And how did you find this deal?
So this one actually came to us, an investor colleague of mine uh, said, "Hey, we've got this property. The seller might be thinking of selling. Do you know anybody?" And I took a look at it and said, "Yeah, I think I'm that somebody. Can you introduce me to the guy?" And that's how we came across this one.
Nice. So do you mind running us through the numbers, and perhaps explaining along the way, how the matrix that you look at may differ from single family investing?
Yeah, absolutely. So, I mean, this one was $3.5 million. So in multifamily, we did just a couple of quick checks. Number one check is the price per door about right for the area, considering the suite mix? Yes. Does the net operating income compared to prevailing cap rates in the area support the value? Yes. Okay. So at a glance, it looks like they're asking about the right price for the place. Cool. Let's proceed. Then, so that's kind of our first level of due diligence. Second level of due diligence, nice bonus with the property. They had an existing mortgage that was assumable, and this is going to sound outrageous now in fall of 2022, but the assumable interest rate was 1.7% at a fixed rate. So we said, perfect, and again, this was right before COVID. We closed we closed the deal just as COVID hit. So this was right before COVID. I mean, that interest rate was not outrageous. That's kind of what interest rates were sitting at for multifamily with CMHC. So it was a great interest rate, but nothing too outrageous. So that was a nice perk because it added to the cash flow. So that was the first part of the analysis. The next part of the analysis was double checking to make sure that we knew that it checked more of our boxes. So locationally, I want to be in good quality neighborhoods that are very attractive to a larger database of tenants and close to, infrastructure development. Holyrood fit the bill. Perfect. But you can walk to the LRT, great safe neighborhood. People want to live there. Then from there, we wanted to have a look at the rent roll. So that's one thing about multifamily is, a lot of people assume because there's tenants in place, it's good to go. But the tenants are the asset. The net operating income directly relates to the tenants in place and the reliability of the rent that they're paying. So I'm a big fan of looking at every suite, scoring every tenant on a scale of 1 to 5. If I walk in and they have a bunch of unauthorized pets that are a surprise to the property manager and an ashtray full of cigarette butts and a bunch of bongs everywhere and garbage and whatnot, okay, they're getting a 1. If I walk in and it's prim and proper and smells nice and looks well organized, yada, 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 someone where, it's like, oh, I'd hang out here, then it's a 5. And, for me, paying the rent on time is part of that equation. But, tenant number one, they've essentially done $5,000 to $10,000 of damage to that suite. Like if they leave, like I don't care if they're paying their rent on time right now. If they leave, that's a $10,000 flip over of that suite. So I like to look at the hidden amortized costs that the tenants could be creating, either in missed rent or in the cost of replacing them with a better tenant. Once those numbers add up, okay, now we're working with a building that I like. And then we get into the inspection phase and make sure like all the big ticket items, roof, windows, boiler, whatever, those numbers are workable. And that's kind of the due diligence process. So with that particular building, we were cash flowing about $6,000 a month, which is good but not great. But for us, the real value in that building was the location, and then the property itself was actually sitting on an unusually large lot. Look, I'm making a little friend here. Oh, there's.
Here we go.
There we go. That's what you get when you're out in the neighborhood for a walk. For those of you guys that are listening instead of watching, a cat came up and started rubbing on my leg. That's the due diligence process we follow. So there's an intangible value in the land, especially in Edmonton, where you can't always rely on appreciation. It's important to pick pieces It's important to pick pieces of land that are likely going to appreciate even if the whole city doesn't. We want pieces of land that will. And we knew that that was a large piece of land in a location that should be appreciating because of its proximity to the LRT. So when I think about that acquisition on like a 20-year timeline, it's an older apartment building, but that's a site that it's already zoned for up to 10 stories. And so without too much fuss, at some point in the future, we could very easily be putting an apartment building on the site. And so, with all of those factors combined, it added up to a deal that we wanted to pursue. So, in the spirit of not over leveraging, we thought about $1 million would be the right amount to raise. Nice round number, and we set out on raising 4 equal parts of $250,000. That raise took about 35 days, and then we were ready to rock and roll.
Wow, you touched on a lot there. I actually have a few questions.
Yeah.
So okay, let's just go back. So yeah, so when you walking through, looking at the property, like you say, looking at the big ticket things, the boiler, the windows, that sort of thing, are you just looking at the remaining lifespan on that, the replacement cost, and then sort of working out the budget backwards that way? Are you opposed
Yeah,
to?
exactly.
Okay, perfect. And then are you trying to also time that with perhaps doing since you'll be doing major innovations, then at perhaps looking at that stage to expand the property? Will you just sort of reevaluate at that stage?
Yeah, I mean, at some point, everything needs to get done.
Yeah,
And so, I know that at some point we're going to tear the property down, but it's not going to be anytime soon. So we're not
okay,
going to try to squeeze an extra 4 years of life out of a leaky roof or
yeah,
let a really old, inefficient boiler chug away, costing us in utilities. With this building, we've already replaced one of the boilers, one of the hot water tanks, and we had to do a bunch of external landscaping, which was fine. I almost prefer it if that stuff just needs to get done because then, like, if it's in bad enough shape that it's practically falling apart at the seams, perfect. Because then there's really no argument that the seller can get into. You price it into the value, and then in commercial, very, very common to get construction mortgages, which means that the cost of the renovation is just built into the loan that you're given. And then boom, you're right out of the gate with brand new components that are fresh, warranted, and ready to go.
yeah.
So I'd almost rather that scenario than, a furnace that's 3/4 of the way through its life, and now I've got a ticking time bomb
Yeah,
that could
exactly.
be that could be requiring replacement in 5 years. Because then I have to come up with the money in 5 years. Whereas if I have to do it now, I can work it into the
And
mortgage.
yeah, that makes sense. And I was also going to ask, I know a lot of people's strategy in multifamily is come in, do some renovations so that we can increase the rent, obviously increase the value of the property that way. Was that your
Yeah,
intention on this one? Or was this just, it's a good deal, the numbers work? I'm not looking at, turning tenants over, not looking at renovating at this time, just keeping it as is?
definitely keeping it as is. Yeah.
Okay.
This one, it's a particularly rare piece of land. Like if you go around the neighborhood, there's no other multifamily building like it anywhere in the neighborhood. That's that close to the LRT. So, I mean, it makes perfect sense for us to approach it, and that's what we did. So we have done the approach in the past where you find a building that's undermanaged. Either the rents are naturally low because they haven't increased them, or there's an opportunity to improve the suites and the building to increase the rents. Um, to That's a great strategy. That's a strategy that multi and family investors particularly love bragging about because if you get a
Yeah.
win, um, you can usually win pretty big, but it's always proportional. I mean, if you can increase a building's value from 2 million to 2.2 million, that's the same as increasing a house's value from 400,000 to 440. It's not it's not any bigger of a win proportionally than doing like a burr to a house. It just looks sexier on paper because it's millions of dollars involved instead of hundreds of thousands. But I mean, that's a fine strategy. But from my experience, you're actively adding value to the building in one way or another, and that's a heck of a lot of work. So the money you generate does come at a cost of added risk and added complexity. But I mean, we've done it. We've added a ton of value to buildings in the past, and it's been terrific. Um, but I think there's a misconception that it's only possible in multifamily and that it's more profitable in multifamily. And I wouldn't say that's the case. I would say, if you like in Edmonton, it's such a classic to buy a sleepy old bungalow that's in rough shape and then renovate it top to bottom and put a legal suite in the basement
Yeah.
and add, anywhere between 20 and 50 or 60,000 in value, depending on how much of the work you do yourself and how good of a job you do. And, that's a very fine project where you can create a bunch of equity that I think is just as solid as what we're talking about in the commercial multifamily space.
Absolutely. And another bonus to that is you increase your monthly income as well.
Exactly.
Yeah. So with regards to this deal, what was the whole process like? Were there any challenges? And if so, how were you able to overcome them?
Yeah, I've never ever done a deal that didn't have at least one challenge.
Yeah.
I would say the biggest challenge with this deal was that we was actually a partner challenge. We had one partner who just wasn't willing to act with a sense of urgency, and so we kept having to ask the vendor for extensions, and then and then we had to get the financing package redone because we missed a couple of deadlines. And this partner was, for all intents and purposes, should have been a great partner, high net worth individual, real estate savvy, but just, it was like dragging a child who's kicking and screaming along through a deal. And they kept, they said they wanted to do the deal, but they sure didn't act like they did. And so, I mean, the deal just ended up costing more money and taking more time for no good reason other than this person was just very slow to do everything that was necessary to get the deal done. And, that's a unique challenge. The building itself was actually terrific. I mean, no surprises, really. No surprise bed bug infestations or terrible tenants or anything like that. It was, it was just the partner ended up being the challenge in this deal. Then ultimately we got it done, but if I did it all over again, like I bless this person's heart, I don't know if I'd ever do a real estate deal with them again because they were, as much as they have money, they made themselves pretty difficult to deal with, which was what it was.
Yeah. Yeah, exactly. You actually just answered what my follow-up would have been is, looking back, would you have done anything differently? But I like what you mentioned is that, you've had challenges with every deal. And I feel like newer investors, if they can come into this knowing that there will be challenges, they could sort of just better shift their perspective and mindset, knowing that it's still worth it. You just rise to the occasion, pivot, persevere, do what you need to do, get through it, go to the next one. But there's always going to be challenges, and that doesn't mean that it's not worth it. So that's why I love doing these, where we dive into a deal and we just see how you were able to overcome those challenges.
Totally. I mean, real estate investing is extremely profitable, but anything that's profitable is usually kind of tricky. So it's part of the reason you're making such a sizable return is because you're in the business of solving a lot of problems. And once you wrap your head around that, it's like people who get emotionally invested in problems are the ones that, it's like the kind of person who calls a problem a headache. I just don't want any more headaches. Well, if problems are giving you headaches, that mindset alone is what makes this not enjoyable.
Yes.
Whereas if you think to yourself, I'm in the business of solving problems, great. We're in the business of solving problems. What's the next problem? I'll solve it. That's what I get paid to do.
Yeah. Challenge accepted.
Precisely.
Another part of building a successful business is building your brand. And you've not only done this on a personal level as an investor, creating trust and obtaining money partners to joint venture, but also creating a successful realtor team. Now, not only in Edmonton, but in Vancouver as well. What are some things that you've learned when it comes to building your brand?
Ultimately, you have to build a team of people you can trust. That's what's allowed me to exist in two cities. I mean, I can't be in two places at once. And even as an investor, as you grow, you can't be in two places at once. It's easy to do it all yourself when you have one property. But if you do a great job with one property, it's not too long before you have two, then four, then eight. Um, so it's all about the people.
Okay. And but like with regards to actually building your brand, how would you say you've gone around that? Was it just putting the right people in place to assist you in building your brand? I mean, even on your personal level of being a real estate investor outside of being a realtor, I mean, they kind of they tie together, but I feel like you've done a great job at that with regards to your realtor teams.
Thanks. Yeah.
Um and and you have to have done a great job um on your investor side to have scale that big. Now that doesn't mean building your brand on social media. Your brand, it goes beyond social media, right? It's what people know you for. So just within the investor community, um, what have you done? What advice would you have for people trying to build their brand out there so that they can,
Yeah.
attract more money partners, whatever it is that they missing, that, or that link to their puzzle piece?
Brand building for me is just all about, quite simply, for anybody listening, when people think about real estate, they think about you. So that's the end goal, is when somebody thinks real estate, they think El Rey. When somebody thinks real estate, they think James. So if that's the objective, well, how do you make that happen? A couple of easy things that you can do. I would say number one is, I always say, if there's a spotlight, get into it. However you can get into it, whether it's, accepting El Rey's invitation to come speak on this podcast, or posting on social media every day, just something about yourself or something about your real estate journey. For people that suck at social media, I always just say, answer the question, what am I doing right now? Am I reading a real estate book? Am I flipping through MLS? Am I looking at a spreadsheet? Am I listening to a podcast? Whatever it is you're doing, just make a post about it. Because the thing about social media is that it allows you to create your own spotlight. So that's a really easy technique, is anytime you can have people paying attention to you and you can say something about real estate, big or small, take that opportunity. And that will build your brand lightning fast, because the people on the other end of that spotlight, if they say you and they see real estate, they have no idea if you've been doing it one day or 10 years. They're just going to see you and think real estate. And that's a massive impact on your ability to get people to think that thought. And then the other thing is, I think integrity is really important. And when I think about integrity, I think really you want people to think of you as someone who does what they say they're going to do when they say they're going to do it. So it's almost better to do less, but do everything you said you were going to do, than be a big talker, an overcommitter, a non-executor, a non-finisher. Do less, but do what you said you're going to do, and people will say, "Oh, that person, they're the kind of person that gets things done, and I can trust them and rely on them." And when people think about you in real estate, and they think about you as someone who gets done what they said they were going to do, they'll ask you to be doing business.
I love that, because it's building trust, right? You need to be building people's trust, and rather under promise, over deliver, or under promise and deliver than over promise and under deliver, because your reputation is everything. So have that integrity. I love that. And I think one thing that you also did well, going back to us starting off this interview, was at building your brand, was going to anybody who would listen to you and doing your presentation. I mean, that in itself shows people, hey, you interested in real estate, you doing real estate. So I think any opportunity that you could is showing people what you're doing, who you are, what you're about. So I love that. And my next question, you kind of touched on before, was like, what advice do you have for someone trying to scale their real estate business to the next level? And I think you touched on it when you said, people. I think that's a big factor, but I'll let you answer this. I won't answer it for you. Yeah. Any advice? Anyone trying to scale, take that real estate business where it currently is, whether it's starting out, whether it's, 10 units, 20 units, whatever it is, just to take it to the next level?
Totally. Yeah, I'd say scaling comes at the point where you're ready to do your first delegation. And for most people, the first delegation is an assistant. People think, oh, I have to hire a full-time staff at 40 hours a week. That's a big financial risk. But with the way that um, virtual assistants, Upwork, gig-based economy, like you can hire people for all kinds of small items and then work your way up. So for someone who's, we're all entrepreneurs, we're used to doing everything ourselves. We want to hold on to every little task. So a good way to scale is to get very, very granular, get atomic in what it is that you do, all the things that you do, and start writing them down in a big list. And then beside that, write how many minutes it takes you to do that thing. And then look at the things that are the easiest to do that take the most amount of time and pick those off first. So, a lot of people say, oh, you got to hire a bookkeeper. Well, some people really don't trust counting their money to somebody else. So maybe don't hire a bookkeeper. What requires way less brain power that is really hard to screw up? Well, if you have to get keys somewhere, hire a courier. Spend the money it costs to get the keys driven to where they need to go. If let's say that you've really gotten this joint venture thing going, but you've been a little bit naughty with your contact management, and so now you've just got emails and scraps of paper and all kinds of contact information in all kinds of places, and you're ready to scale and get serious about being in touch with more people. Well, maybe you just take that big pile of paper and have somebody make sure that it's consistent through your CRM and every single person is friends with you on social media. And all of the contact information is accurate in one contained place. Little things like that are wildly time consuming, but really hard to screw up because they're easy, mindless, repetitive tasks. If you start with that, that's kind of the first step in scaling up. And then once you get good at that and comfortable with that, then you can start handing off progressively more difficult tasks. And good help is relatively easy to find as long as you're not paying the cheapest of the cheap price tier. If you break pricing into 4 tiers, stay away from the bottom tier and stay away from the top tier. But if it's somewhere around average or slightly above average, chances are you're going to find competent people.
I like that because you'll somewhat get what you pay for, and if you go for the cheapest one, there's possibly a reason why the cheapest are where they are. So that's actually a great tip. And listing it out, it may sound time consuming, but I know that's a very productive way or very easy way to see where those leaks are, and you can those time leaks, and you can get rid of those, take those off your plate, and focus on the more important things, the things that give you the highest ROI of your time. So great advice. Now, one thing that I know that's a crucial part of real estate, of investing in real estate, beyond owning a few properties, is networking. That's where you find solution to your problems. That's how you find strategies to level up, how you find members for your power team and possible joint venture partners. The team at Mogul Realty Group do an awesome job of bringing local investors together every month to network. Not only do you guys cover a specific topic each month and have speakers come up to discuss it, you guys are bringing investors together. So I urge listeners out there to go out and join in on these events, join in live. I know you have the option to join in online as well. And I mean, it's okay if you can't make it to these events, but some local events have an entry fee, but from what I've seen, your guys' meetups don't have any entry fee. So I think there's literally no excuse to join in. That's where the magic happens. And that's one of my key tips on taking your real estate investing business to the next level. I know when I started putting myself out there and networking, opportunities just opened up. So that's one thing that I like that you guys do. I know you guys do it, if I'm not mistaken, the last Wednesday of every month.
That's right, yeah.
Yeah, so anybody listening, if you are in Edmonton, I don't know if you guys do it in Vancouver as well.
In Vancouver, we do. We get our VIPs together and do a little watch party in Vancouver. So if you'd love to come down to our office and enjoy a snack in our boardroom and hang out, we watch the broadcast and then we can have in-person networking during the meeting. Because you're absolutely right, El Ray. The value of networking in person is that you end up being 100% present. When it's on Zoom, you've got the TV on in the background, the kids are making some noise. Maybe you have a dual monitor and you're reading your email at the same time. The conversation quality degrades substantially versus just being in person, eye to eye with somebody, focusing on what they're saying and having a true conversation.
Exactly. Yeah. Not only learning, but building those relationships.
Exactly.
What I also like about Mogul is that, you guys aren't, like you mentioned, you need a investor focused realtor, right? But you guys aren't just investor focused realtors. You guys are investors yourself, which is exactly what investors should be looking for when they put in their power team together. So, that being said, James, where can listeners find out more about you, Mogul Realty Group, and more about the local investor meetups? I'll be sure to leave it in the description below as well.
Yeah, check out our website, mogulrg.com. Find us on Facebook, mogulrg, or on Instagram at mogulrg. And then I don't mind people reaching out to me directly, so I'm easy to get a hold of. It's james at mogulrg.com if you just want to say a friendly hello or ask a question.
Perfect. Perfect. Now, I have one question that's not real estate related.
Sure.
When you're not investing or working on the business, because you're an entrepreneur as well as an investor. So when you're not investing, when you're not working on the business, how are you spending your time?
Going down the side of a mountain as fast as I can. Mountain bike in the summer and skis in the winter.
So you chasing that adrenaline rush?
Yeah, I mean, I just love being out in the fresh air, and I have a reputation among my friends for going pretty quick. I just think it's fun. It's one of my favorite hobbies, and I really, really enjoy it. So that's and it's great for networking. I mean, it's a good place to find joint venture partners because they're both pretty expensive hobbies, and so the kind of people you typically meet doing them are the kind of people that like talking business.
Yes, yes. Now, I know I'm from South Africa. There's no snow back there. When I came to Canada, I was like, I have to try skiing out, and I loved it. I went straight down. Some people go side to side. I went straight forward, and that rush, that wind in your face, it's it's an impeccable feeling. So I can somewhat relate. Haven't had the guts to mountain bike down, um, down a mountain, but maybe one day.
Hopefully, you get the chance. It's very fun.
Yeah, yeah. Um, But yeah, honestly, James, I want to thank you so much for taking time out of your schedule, bringing our listeners all this value. I know you bring a unique perspective to all the guests that I've had, so I'm sure the listeners found value in this episode. And I know you're a busy man yourself, so I really appreciate it.
Oh, it's been terrific to get a chance to chat with you, El Ray, and thanks to everybody for tuning in.
Thank you for tuning in to Building Wealth Through Real Estate. If you've made it this far, then there is no doubt that you're serious about real estate investing. So I'd recommend you check out the interview with Wayne Hillier. He goes through what separates successful investors and breaks down practical steps to implement. This is your host, Alray Noble, signing off.